had a very interesting time so far tonight. I actually think a lot of the speakers that have already come before me have probably covered a lot of what I actually wanted to say tonight. I also saw last night when I was feeding my son that there was an article on, there's actually a program on BBC about bankers. I'm not sure if anyone else saw that, but it was talking about basically mis-selling in the UK and all that PPI and their actual interest rate hedging products sort of mis-selling. And there was some actually quite bad examples there. But what was interesting was that, you know, the CEO of Lloyd's and those other CEOs and the chairman of the CEO of the British Banking Authority would come out to say, yes, you know what, we have to change our culture, we have to change our behaviours. Our current practices aren't good enough, and we have to obviously stop, you know, trying to find profit and look for profit and actually put our customers first. And my first thought was, you know, that's actually, you know, just come across quite well. That's what the regulator would actually want them to say. The second thought was that, you know, they've stolen my presentation tonight because you know, if you watch that program, I'm pretty much covering the same stuff. So I'm going to give a summary of what they said. I guess the first question is, you know, can boards take a long-term view? Of course they can. I think the challenge is like how to ensure that they actually prioritise a long-term view over a short-term view. You know, what we see at the regulator and what I've actually seen in some of my own research is that some boards actually do take a long-term view, but many don't, and that's what we've actually seen in the media today. There's a lot of media attention about boards actually putting profit first, high-risk products, high-margin products, you know, boards not really checking up on what their management is doing. And what we can also see is the cause behind that is the different behaviours, the different culture, the different values, the different priorities around remuneration that different boards have. So in the UK and the US, we've seen a definite shift to say, you know, profit first, shareholders first, let's pay ourselves first. But there's also, if you look at banks in Scandinavia, for example, they came out okay during the crisis. You know, they were putting their customers first. It was a balanced view. So I think the question for boards to actually, can they take a long-term view? They can, but it will actually require them to hold on to some values that will enable them to be tough and strong when it comes to challenging their management and saying we care about our people, we care about our staff, and we don't want you to actually make as much profit as what you are doing. That will also require, though, and I think past speakers have actually mentioned this, that there is a culture, there is a pressure from shareholders to make money, and boards are people, you know, like all of us, and they're susceptible to pressure, and if you don't perform, you're out, and if you do perform, you get rewarded. So there's that sort of dichotomy to say that, you know, boards, you know, they perhaps should take a long-term view, but the motivation isn't perhaps there yet, and I think that's one thing that, you know, that will have to change, and that's part of the public's, I guess, you know, job is to actually say that let's encourage that change within boards. The next point was talking about how boards can actually, you know, I guess what we're seeing here in the program that I actually highlighted yesterday was that they gave a good pitch about what they wanted to do, about their values. This word about social usefulness has actually appeared now, and I think that's actually something that probably hasn't come up quite recently. But again, what we see is, you know, at this point in time, boards are talking about their values, their culture, and it's not all about profit. It's about being benefits to society. It's being about customer focused, as if it shouldn't have been in the past, as if it wasn't. So, but what we are seeing is that it's up to boards now to say it's not just about, you know, making a return for shareholders. We want to be of benefit to society. We actually need to start looking at being a little bit less complex, and a lot of what I deal with as a regulator is looking at what, you know, how boards actually look at behaviours within their organisation to say, you know, you're telling us about you're wanting to put your clients first and your customers first, but in effect you're still trying to sell and push high risk products. You're still trying to meet your quarterly targets, even monthly targets. You're still telling us about the fact that you've got to meet your return on equity requirements, your EPS requirements. It's not about you telling us that you're looking at your development of your staff, development of your people, that you can actually measure how society is benefiting from the service that you provide. So I think again, the challenge for boards is I think in a lot of cases they might say they want to do the right thing. The question is, do they have the right tools? Do they have the right support from management? Do they have the right support from public? So I think when it comes to actually walking the talk, how we kind of see it as a regulator, and I think personally what I see is, I think boards have to actually be a little bit stronger now to say, look, you know what, we're not just going to pretend that we don't know what's going on, such as PPI and other selling. It's kind of saying, well, the honest thing is we can't just close our eyes and say it's about, tell me management how much money you've made this quarter. It's about how have you made this money this quarter. It's not just about what profit have you achieved for our shareholders, but it's about how have you actually provided a benefit to our customers and perhaps the wider market. At the moment, boards don't get that. And I do see the fact that it's changing. I mean, we are seeing a groundswell of disapproval in the industry about banks. I mean, you see them all over the media. I'd feel quite sort of vulnerable as a banker these days. I mean, it's not sort of the most honourable profession. And the reality is again, from this BBC article we saw last night, banking was an honourable profession 30 years ago, and it's kind of lost that sort of place in society. And I think what boards have to do is say, we want to get back to being a bit more of a utility. We want to show a benefit, and actually we will start to challenge management and ensure that how we measure success isn't just about profit, about EPS, about the sort of financial measures. It's about, tell us about how your people have actually developed, tell us about how you've reflected the benefits of society. But I mean, I think, like the previous speakers have talked about, there's a lot of pressure at the moment on boards to perform day in, day out. They don't get a lot of opportunity to say, don't look at what we've done over the last 12 months or 2 years, just close your eyes and come back to us in 3 years' time and we promise that we've actually done a good job. So until I think the public, the wider public, the reporting community, people such as yourself, Dr. Reddy, Raj, to actually get that groundswell of opinion and support for boards, we won't see that meaningful change. But the moment we do, I think there will be a lot of buy-in from the banks to say, to ensure our survival, we will have to actually be a lot more people-focused.
I think you're right in one of the first things you said, by the way, which is that I think a number of the presentations do overlap, and I think that's inevitable. I was thinking that it must be frustrating for regulatory organisations like FCA to be able to chase around the kitchen table, chase Starbucks and Sunbanks and Vodafone, and then impose a fine that's really a pinprick as far as the... So my member's going down. Would there be ways, I'm sure your answer would be yes, but can we find ways in which you, as a regulatory authority, can have more teeth in this sense that beyond fines, okay, there was a public accounts committee, wasn't it, this week, that really took Google to the cleaners in terms of their failure to pay their taxes. That's a sort of name and shame kind of approach. Is it possible we could go one step further? People talk about carrots and sticks. You don't really sell carrots to people who are dining on caviar and champagne.
No carrots, Michael, no.
But sticks do often work. And I think Kay mentioned it, or Lord Miners did in his response to this, that the Law Commission could be brought into account here. And if one takes fiduciary duty as key to the board's behaviour and the board's performance, we could put a stronger system in place whereby people could be actually, the executives that you can only find now could be actually brought before the court, and it would become a matter for the courts to settle. Is there, that would be the kind of strong pushback that I'd love to see. Is there, am I just dreaming?
I wouldn't say no. I mean, I think the thing with the regulator is that they're bound by a Financial Services Market Act at the moment. And I mean, criminal prosecutions, do occur in some circumstances. I think the hardest thing for the regulator is that the burden of proof is all on the regulator. I think we have in the UK at least an approved persons regime where, if you're a CEO or a member of a board or someone who's actually got an important function within an organisation, you're actually required to have a higher degree of responsibility within the organisation. So if something falls down, then you'll become more liable, and there has been examples in the paper recently that you might lose your ability to work within the financial services industry for 3 years, 5 years, 7 years, or even a long time. But I mean, I've been at the FSA, regulator now for about 4 years. I must admit, I've seen an approach, the approach has changed. I wouldn't say we've got sharp teeth. Probably we have blunt teeth, but we have teeth, whereas perhaps, pre-2008, there was no teeth. So I have to say that there's definitely an improvement there. I think someone was talking before about the fact of, it's just what can the regulator do? And, the regulator's also gone through a shift in trying to be tougher on firms. But I know one thing they are looking to do, it is more of a people thing now. So they are starting to look to say, let's not look at just how you do your business. We want to see about the values, about the behaviours that undermine and underlie your business. Tell us about why this is actually good for your customers and for society. So I think there is slowly a push to say we actually we're forcing firms to look at more things than its figures. The next step would be perhaps, yes, more draconian fines or criminal prosecutions. Maybe the next step would be to say, well, if we're given the powers, I think it will be, I think we're a little bit different than perhaps sort of our US cousins, where I think it seems easier to go for prosecutions than it does over here. But I do sort of see that as the groundswell of opinion changes, laws change. We've all seen, every MP, or not every MP, but a lot of MPs are on this issue now. It's important because the public have spoken. So I think as time goes, we might actually start to see that, those sorts of penalties come into play.
Thanks very much, and thanks for taking your time.